the most boring word in finance. Bonds. Your eyes are already trying to leave. Good. Because the most powerful market on earth survives on exactly that reaction. It needs you bored. It needs you looking somewhere else. That's how it works undisturbed. You've never bought a bond. You're sure of it. And yet, your mortgage rate, your credit card, the loan on your car, all three answer to it. There is a market that decides what your money costs. You've never once looked at it. It doesn't send you a statement. It doesn't have an app. It doesn't want your attention. It just quietly sets the price of everything and lets you argue about the rest. The stock market gets the cameras, the drama, the red and green all day. People check it on their phones like it's a sport. They cheer. They panic. This market gets nothing. No coverage. No hype. And it's many times larger. It's the quiet kid in the back of the class who actually runs the school. Here's what I'm going to prove to you in the next few minutes. You are already in the bond market. Deeply. You're just sitting on the wrong side of the table. Not the side that lends. The side that owes. And once you see which side you're on, you can't unsee it. So let's open the one market that runs all the others. Start with the simplest version. A bond is an IOU. That's it. Someone needs money now. They promise to pay it back later with interest. You hand over $100. They hand you a piece of paper. The paper says, I'll give you your 100 back in 10 years, plus a little every year for the wait. That little every year is the reward for not spending your money today. That's all interest ever is. It's rent. You're renting your money out, and the interest is the rent check. A government does this. A company does this. The mechanic is identical. When you buy the bond, you're not the borrower. You're the bank. Sit with that for a second. Most people go their whole lives only ever being the borrower. Never once the bank. The person who holds the paper is the lender. The one who issued it is the one who owes. Now here's the part that turns a boring IOU into a market. You don't have to hold that paper for 10 years. You can sell it tomorrow. To someone else. For whatever they'll pay. And that price moves every second. Which means a bond isn't just a loan. It's a thing that trades like a stock with a price that breathes. And when the price of the world's safest IOU moves, everything else has to move with it. The biggest version of this is the U.S. Treasury market. The government's IOUs. It's the deepest pool of debt on the planet. Trillions of dollars change hands in it daily. Every mortgage desk, every bank, every foreign government watches its price. Because that price is the closest thing the world has to the true cost of money. When people say something is as safe as treasuries, this is what they mean. It's the floor everything stands on. And when the floor shifts, every room built on top of it tilts, including yours. Here's the one piece almost nobody catches. Bond price and yield move in opposite directions. It sounds like a technicality. It's actually the whole story. So let's walk it slowly. Picture a bond that pays $5 a year forever. If you pay $100 for it, you're earning 5%. Simple. Now the crowd gets nervous. Nobody wants that paper. The price drops to $80. The bond still pays $5. But 5 on 80 is over 6%. The price fell and the yield went up. Same paper. Same $5. Nothing about the bond changed. Only what people were willing to pay for it. Read that again. The reward went up precisely because the confidence went down. So the yield isn't really about the bond. It's about the mood of everyone buying it. It's a fear gauge wearing a % sign. The more the fear, the higher the number. So when you hear yields are rising, translate it. Somebody is selling. Rising yields don't mean the market is happy. They often mean the opposite. It means buyers are demanding more reward to hold the debt. They want to be paid for the worry. And that worry has a name. Actually, 3 names. Inflation. Debt. Doubt about getting paid back. Inflation because a fixed payment is worth less if prices keep climbing. That $5 buys less bread next year. So you demand more of it up front. Debt because the more a borrower owes, the less sure you are they'll make good on it. And plain doubt because trust is the only thing holding the whole promise together. A bond is a promise with a price. When the promise looks shakier, the price falls. When any of those rise, the crowd sells, the price falls, the yield climbs. That climbing yield is the market speaking. It's the only vote that clears instantly. No election, no press release, just a number moving, telling you what money now costs. Every other market gives an opinion. This one issues a verdict, and everyone downstream pays it. All right, here's where it stops being abstract and starts being your bank statement. Most people think the Federal Reserve sets their mortgage rate. It doesn't. Not directly. This is the single most common mistake people make about their own money. So let's kill it now. As of mid-2026, the Fed's rate sits between 3.5 and 3.75%. But the average 30-year mortgage is running around 6.5%. If the Fed controlled your mortgage, those two numbers would sit a lot closer. There's almost 3 full points between them. That gap is your first clue. They don't. Because your mortgage doesn't follow the federal. It follows the 10-year Treasury. Here's why. The Fed's rate is an overnight rate. It's for banks lending to each other for a single night. That's a useful number for short, fast money. It is a terrible match for a 30-year home loan. Because your mortgage isn't overnight. It's a 30-year promise. So lenders don't price it off a one-night loan. They price it off a long one. And here's the clever bit. The average American doesn't actually keep a mortgage for 30 years. They move or they refinance in about 7 to 10. So the real life of the loan is shorter than it looks. So the number that fits that timeline is the 10-year Treasury. That's why your mortgage tracks it. Your lender takes that 10-year yield and stacks a margin on top. A spread. Usually 1.5 to 2 points. That spread is their cut. Their risk, their profit, their cost of doing business. But the base is the Treasury. So when the 10-year moves, your mortgage moves. Even if the Fed does nothing at all. You can watch the Fed hold rates perfectly steady and still watch your rate climb. That's not a glitch. That's the bond market doing its job in the background, while everyone stares at the wrong number. Now let me show you what 1 point of that yield actually costs you. In dollars. Real ones. Take a $350,000 mortgage. 30 years. Fixed. At 6.5%, your payment is about $2,210 a month. Push the yield up 1 point. Now it's 7.5. Your payment jumps to $2,445. That's $235 more dollars. Every single month. For 30 years. It doesn't feel dramatic. It's not a crash. It's just a little more. Forever. That's the trick of it. The bond market never sends you a bill that says yield. It just quietly raises the one you already pay. Do the full math and it's over $84,000 in extra interest across the life of the loan. $84,000. Decided by a market you have never opened. That's a car. A college fund. A decade of vacations. Gone into the spread over a number you didn't watch. And it doesn't stop at your house. That same rising rate environment feeds your credit card. The average card APR is now around 21%. Your car loan, your student loan, your business line, all standing downstream of the same river. The bond market sets the current. Everything you borrow just floats on it. You don't feel the current. You just feel the price. And you blame the bank. The bank's just downstream too. Let me tell you about someone. Call him a first-time buyer. 29. Good job. Careful with money. He does everything right. He saves for years. He builds his credit. He reads the articles. He watches the Fed like everyone told him to. He waits for the rate cut that's supposed to come. He's got a spreadsheet. He's got a plan. He thinks he's watching the thing that matters. One Tuesday, somewhere he'll never see, the Treasury holds an auction. Ordinary. Routine. This happens constantly. The government sells fresh IOUs to fund itself. Nobody outside finance notices. Buyers show up soft. Demand is weak. Nobody wants the paper at that price. So the yield ticks up. A few tenths of a percent. A blip on a screen he doesn't watch. He never heard about it. There was no headline he'd recognize. No alert on his phone. The Fed didn't meet that day. Nothing he was watching moved. But the thing he wasn't watching did. 2 weeks later he locks his mortgage. And the rate is higher than his friend's from last month. Same house price, same credit score, same bank, a higher number, and he can't explain it. He asks his lender why. The lender shrugs and says, "Rates moved." They did. In a room he'll never enter, over a paper he'll never own, weeks before he even applied. He's now paying for a bond auction he didn't attend. That's the whole game in one man's mortgage. And here's the quiet part. He'll never know. He'll just assume that was the rate. That's how invisible it is. Now scale it up. If the bond market can move your mortgage, ask what it can move above you. Because the same force that quietly repriced one man's loan also has a much bigger target. In the early 90s, a new administration came in with big spending plans. The bond market looked at the size of the deficit and didn't like it. So it did the only thing it does. It sold. Investors dumped treasuries. Between late 1993 and late 1994, the 10-year yield rocketed. From around 5% to over 8%. In roughly a year. They called it the Great Bond Massacre. No protest. No march. Just enough investors quietly refusing to buy at the old price. The message to Washington was blunt. Rein in the spending or borrowing gets expensive for everyone. And the government listened. It cut the deficit hard over the following years. From roughly $290 billion in 1990 to about $70 billion by 1998. A government changed its behavior. Not because of an election. Because of a price on a screen. Let that land. Voters didn't force the turn. Traders did just by stepping back from the table. One of the president's own advisors put it best. He said the bond market can intimidate everybody. Think about that. Not the voters. Not the press. A market of bond traders. Intimidating a government. There's even a nickname for the investors who do it. Bond vigilantes. They don't wear badges. They don't organize. They just refuse to buy at the old price. And that's enough. Because a government that can't sell its debt cheaply is a government in trouble. Fast. You might think that's ancient history. A 90s story. Interesting but old. So let me bring it to now. In April 2025, a sweeping new tariff plan hit the markets. Stocks fell. That was expected. Then something strange happened. The bonds fell too. At the same time. And that's the tell. Normally, when stocks crash, money runs into treasuries for safety. That's the reflex. The safe corner. This time, money ran out of them. Both markets bleeding at once. That almost never happens. The 10-year yield jumped more than half a point in a single week. The biggest weekly move in years. When even the safe corner isn't safe, that's not a dip. That's the market questioning the whole plan. That's the market saying it doubts you. Loudly. In real dollars. All at once. Within days, the administration paused most of the tariffs. Not after months of debate. Days. A long weekend, basically. And officials admitted it out loud. The bond market, they said, was telling them it was time to move. The same economist who named the vigilantes decades ago wrote 4 words. They've struck again. 1994 took 13 months. 2025 took a long weekend. Same mechanism. Faster. The market that runs your mortgage also just rewrote national policy in days. That's the thing you've never looked at. And it moves faster now than it ever has. Now let me be fair, because the bond market isn't a villain. That would be too easy, and it wouldn't be true. Most of the time, treasuries are the safe corner of the room. April 2025 was the exception, not the rule. When the world panics, money usually floods into them. They're the parking lot for scared cash. That safety is exactly why they're so powerful. The whole system is built on trusting them. And bonds aren't a scam to avoid. For a lender, a bond is a steady, boring paycheck. For retirees, for pension funds, for anyone who wants to stop gambling, that boring paycheck is the point. The point isn't that bonds are bad. The point is which seat you're in. Because there are 2 seats at this table. The one that owns the paper, and the one that owes on it. The seat that owns collects the interest. The seat that owes pays it. Same market, opposite lives. So here's the part you know is coming. The turn back to you. You've spent your whole financial life on the borrowing side of this market. The owing side. Every time you took a mortgage, swiped a card, financed a car, you were the IOU. Someone, somewhere, bought a bond backed by your promise to pay. You were the product. You thought you were a customer. You were a stream of payments someone else gets to own. The government funds itself the exact same way. Its 39 trillion in debt is just a mountain of IOUs. And a huge share of those IOUs is owned by everyday people through pensions, funds, banks. Roughly a third by foreign holders. Over half by domestic ones. The rest by the central bank. Which means the lender across the table might literally be your own retirement fund. So on one side of you, you're the borrower paying the interest. On the other, your pension collects it. You're on both sides of the same table and you never noticed you sat down. You're not irrational for missing this. Nobody designed the system to make it visible to you. Your brain is built to notice what's loud and immediate. The bond market is neither. The slow and silent. The bond market is loud where money is decided, and silent where money is spent. Your side is the silent side. Alright, you know what's happening now. So here's what you actually do with it. You don't have to trade bonds. You don't have to buy a single one. That's not the takeaway. You just have to know that when the news says, yields rose today, it's talking about the price of your life, your rent through your landlord's loan, your card, your car, your next big purchase. All of it. That one line on the news you always skipped. That's the one that was about you the whole time. The most powerful market on earth isn't hiding from you. You've just never been told to look. Now you've been told. So look. So let's put it plainly one last time. Bonds aren't boring. They're just quiet. And quiet is how the most important things get overlooked. It's the market that disciplines presidents and prices your mortgage in the same breath. It moved a government in the 90s. It moved a government in a weekend last year. And it moves you, not because it's cruel, because it's honest. Price is trust, and trust is never free. You never signed up for it. You never opened the app. There is no app. But it's been setting the terms of your money since the day you took on your first loan. You never bought a bond. The bond market still owns your mortgage. Now you know which side of the table you're sitting on. That's where it starts.